I was not following the news that much during the American banking crisis of 2008. Maybe there's some people who were listening to that podcast was like, I wasn't even born in 2008. But there was a big economic banking crisis in 2008. And so what can explain what happened in the US versus the Canada, which, being so close to the United States, and, when they get a cold, we sneeze.
Mm-hmm.
So, but from my memory, we didn't get hit as hard. Can the regulation you mentioned earlier and the risk management be part of why what happened?
Well, I think, again, there's two aspects to discuss. First is what caused the crisis in the U.S. and what differentiates the Canadian situation and the U.S. situation. So what caused the crisis? I think this can be a very long topic that can be discussed at length. So, like, we can do a very high level.
What the short ChatGPT version?
Yes, exactly, in a few sentences. And the idea is that there has been a very aggressive risk taking in the banking systems for mortgage loans. So a lot of people were able to take very risky or aggressive loans because banking were starting to develop a new technology called securitization, where they could take these loans, which are very, very risky, package them together, and sell them to somebody else. So they thought they would be able to take the loans and get rid of these very toxic risks and let the financial market absorb this risk.
They thought they found a cheat code, like a loophole. They're like, oh, we found something that works, miracle.
So I'm not sure if it's they thought it was a miracle, but they thought it would help to offset risk. And by offsetting, if you're able to better offset risk, you can be a bit more aggressive and take some more risk. But the idea is like these new securities that were sold to the market, like the investors probably they weren't fully aware of the risk they were taking, and the rating agencies they didn't perform their duties well. So some of these products were very high risk, but they were rated like AA, AAA, or something like that. And there's probably also a portion of just greed and lending practices. So
we never do that.
So some people, like, for example, if you're a portfolio manager, probably your bonus is just dependent on what's going to happen in the next year. But the worst case, like if you do well, you get $1 million, and if you do poorly, then you just get fired. But like you can find another job somewhere else. So sometimes the probably their risk management oversight was not done properly. And the banking system, it's very complex. So sometimes it's not necessarily like dishonest behavior. It's just very complicated systems to oversee and manage. So basically, in a nutshell, a lot of aggressive mortgage risk taking. Plus, this led to a housing bubble. So house prices in some areas of the U.S. they just skyrocketed. And when the bubble burst, suddenly a lot of people weren't able to reimburse their loans. This created losses for these financial institutions that were very aggressive. And the idea is the financial system is very highly tangled together. So like all banks, they lease to all other banks or borrow from all other banks. So when Lehman Brothers, so this is one large investment bank in the US, when it collapsed due to, again, like losing some money, all other banks suddenly who were borrowing or lending money to Lehman Brothers, they thought, okay, I won't be able to get my money back, but all other banks won't be able to. So all other banks suddenly become at risk. So everybody thinks everybody else is at risk of like financial distress or even bankruptcy. So all banks stop lending to each other, and the capital becomes very hard to access. So if you're a company and no bank wants to lend money to you, then sometimes you need to stop doing business and then fire all your employees, and this leads to a recession and more problems for the economy. So this is story short. Like if we want to do a short story, how to explain what happened.
considering what happened in the States, how did we get lucky in Canada? It's just the structure of how things are here that helped us.
Yeah, that's a very good question. I think in Canada we handled better the financial crisis because of several reasons. So first, the regulation on banks is a bit more stringent in Canada. So banks first they need to hold a higher capital buffer. Also, there had been like more strict lending practices, and like the securitization process where banks want to get rid of these toxic loans. This innovation was not as present in the Canadian banking system. So because of that, Canadian banks couldn't be as aggressive in terms of lending practices. So like higher regulatory oversight, higher like capital requirements, less exposure to like these financial innovations, which turned out to do not so well. And there wasn't an acute like housing price bubble in Canada as
I
in the
miss
US.
those days. I miss those days so much. If you're Canadian and you're listening to the podcast, you probably miss those days too.
And not even Canadian, I think in the US too.
Yeah, it's pretty the
It's
housing bubble. It's the worldwide crisis. So you're telling me regulations are good?
yes, well, good and bad. So it
Oh, it
depends.
depends. Yeah.
So too much regulation can cause problems, and too little regulation can also cause problems. So, and this crisis, I think, too little regulation was a problem, but regulation has costs. So, for instance, let's consider more stringent requirements in terms of capital. So, when things go badly or go south, I think we're very happy that banks hold more capital. But when things go well, holding some capital is costly because instead of keeping that capital, if that capital was used somewhere else in the economy, that could create economic benefit. So the banks who are holding the capital, they need to pay investors who are like giving them this capital, and more costs mean this cost is reflected in services that are offered to you. So services are probably more expensive, more costly because of this higher regulation. So I think in regulation there's a trade-off where if you ask for too much buffer, then things become more too costly, but too little buffer, then there's a lot of risk. So knowing what's the right amount of buffer is not an easy question.
Well, it's like basically at the individual level also. Like if you keep all your money in your bank account, if there's a crisis, then the stock market crash, because I don't know exactly the day the episode will be published, but we're in the midst of headlines being about tariffs. Yes, no, maybe, we'll see, maybe yes, maybe not. So if you have your money in your bank account and you're not making much return on investment, and if things crash, well, your money's in your bank account. But if things go well and the stock market goes up and your money's in your bank account, well, it's like, well, oh, okay, well, I missed that. I guess maybe next time.
So it's all about risk reward trade-offs, and in the financial area, a lot of tasks involve optimizing risk return trade-offs. So
So trying to find the balance that probably changes based on many things from the environment and political, economical landscape also.
Exactly.